Things I love to do in my accelerators is to break down assumptions. That there's one way to do it, and that way has been done since the beginning of time, and it hasn't. It's not even close. These are the two first venture capitalists ever. They're still alive. Right? This is Rock and Davis. They invested in a company called Intel in the 70s. That's when they started venture capital. It was new and a breakthrough idea in the 70s, 1970s. And it wasn't really a big industry. There wasn't $1 billion of venture capital spent until the late 80s or early 90s. Kind of a mind-blowing thing if you step back and think about the fact that everyone just jumps in and does it the way that these guys figured out how to do it in 76 or 77. So this book has nothing to do with investing. This is a book on the history of science. So it's called The Structure of Scientific Revolutions by Thomas Kuhn. He was a philosopher of science and history of science, and he invented a paradigm. That's where it was defined, was in that book. And most of us kind of know what it means, but the actual rigorous definition of a paradigm, if you think about science, is a set of beliefs so that when you see evidence that is counter to those beliefs, you ignore it and move on. And you continue to ignore it until you have so much evidence that you simply can't ignore it anymore. Right? So for ages and ages, the Earth was not moving, the sun moved around the Earth. You can see that every day. The sun moves. We don't feel ourselves moving. And people were exiled from the church, thrown in prison for saying otherwise. And yet today, if I said the Earth doesn't move and the sun goes around the Earth, you think I'm crazy. And what happens in terms of science is you finally break the paradigm and it shifts. And so now if I say that actually the entire solar system is based around the moon, well, you'll ignore that and call me crazy because it doesn't fit the paradigm. And the same thing is true of investing. We are stuck in a paradigm. And I didn't come up with that name. I didn't invent anything you're going to see today. I'm just a loud voice in this space. So California capitalism is the idea that you invest money in a company and good things will happen. The antidote to that paradigm is this lecture. This lecture is based on a book. And so I've been doing this for a long time, and what I do when I want to share ideas or just flesh out the realm of ideas is to sit down and write a book. So every year in the United States, about 500,000 new companies get started. I rounded down, it's actually 560,000. But we'll call it 500,000 companies get started. Not all of them want venture capital. A lot of them want venture capital. But this includes every company. This includes the little store in the corner. This includes the company that is mowing lawns for people. This includes babysitters that are doing it professionally. Every company is 500,000 companies. Only, and these are 2016 numbers, what we also know with great rigor is how many got venture capital. And it was in 2016, 4,115. Maybe it was 112, and maybe it was 121. But it was 4,100 something. And we know that for a fact. And every single one of those investments was made with the expectation that it will have a giant exit. Venture capitalists do not make investments in anything that cannot grow huge and sell for hundreds of millions, if not billions of dollars. It's not what they do. And that's the way they've been doing it since Rock and Davis set up the first fund, and Intel did that for them. That was the proof that that model could work. Okay, despite that, there were only 726 good exits in that same year. That's it. And so 4,000 investments has been going on for about 10 years. It's up a little bit, but it's up from 3,842. So of all the companies that got started, less than 1% got venture capital, and less than 0.1% had the exit that those venture capitalists wanted. And yet every investment is made in the style of those exits. And that is simply stupid, right? Not just bad idea and bad business. It's totally stupid. Right? So when you talk to the venture capitalists, you will hear these words. It's unfundable. All these other companies that aren't this little tip of the pyramid are unfundable. Now, how can that be? How can they all be unfundable and yet half of them are still in business in 3 years? And the bad news is half of them are out of business in 3 years, but half of them are still in business. yet they were unfundable. Well, the real problem is the definition of fundable. It's not the startup part. Startups are fine, the businesses are fine, but the structure of the investment makes them unfundable to the venture capital. So we're talking about, in this particular case, when I walk through here, I'm talking about this part of the funding. Friends and family fill in the first funding. In fact, in the $500,000 companies, the average amount invested in a company is $17,000. It's usually from the savings account of the founders or credit cards. Credit cards are the #1 way to finance. And then that runs out, and you need to go find some more money. And so that's the angels and the early seed funds and whatnot. We call that the valley of death because there just aren't enough investors, even in the United States, to fill up that gap. And if you can make it to the other end of that and have some customers and start growing, you get a different style of capital, and I'm not going to talk about that today. And then if all goes well, there's goodness at the end, which is just usually called exits. And in the venture capital model, we're going to stick with the paradigm here for a few slides. The difference in value of the company when you find them and the difference in the value of the company when you're done with them has to be at least 10x. 10 times up. So I'm investing in a company and it has a valuation of $1 million. Unless I'm putting in $250,000 at that valuation. I'm only going to make that investment as a venture capitalist, traditional venture capitalist, if the value of that company can get to at least $10 million. So that's not a big jump, $1 million to $10 million. But the problem is venture capitalists don't write $1 million. They'll write $250,000 checks. They write $5 million checks. So if they're investing in a company with a $5 million check, and they tend to invest in pairs, so that's $10 million into a company that has, to start with, let's say, a $30 million valuation. It has to sell for $300 million to get the 10x. So the question is, where did the 10x come from? And these are, what's crazy is I've done this talk at the Angel Capital Association, which is a group of 70,000 angel investors. I've done this talk in front of startup lawyers. I've done this talk in front of impact investors and whatnot. Everybody knows what an exit is. Everybody knows what 10x is. Those are terms you hear over and over and over again. I went to an event once. I taught at a continuing ed class for startup lawyers. And I counted it. The word exit was spoken something like 42 times an hour for 8 hours straight. It's that ingrained. That is what the paradigm is about. So where's the 10x come from? It comes from this chart. Right? This chart was given to me by the most prolific angel investor in Seattle. He's done 200 investments. All right, so this is for every 10 investments. This is 1 per 10. And it's all in baseball, and for whatever reason, it's always talked about in baseball terms. All right, so for every 10 investments, 1, and only 1 will get that 10x. Oh, sorry, this is a successful portfolio. So if you don't get the 10x, then you lose. Right? So if you have a successful venture capital firm or a successful angel portfolio, 1 out of 10 times you're right, and there's a 10x. And if you talk to VCs and they say, well, I got that big winner, they're totally happy. Right? 2 of them will do okay. And then okay in that terminology is 5, 6, 7, maybe 4. 3 is not okay. Right? 5 times their money back is just considered okay. 3 times they'll get their money back. Could be 4, could be 2. And it's usually exactly the same amount they put in because there's a preference in these deals that say, I as an investor get my money back first. So if I put in $250,000 and the company has a bad exit where the team is hired because they really didn't want the product, and they sell that company for $300,000, I get $250 back and the founders get $50. So it often winds up being 1. And then 4 of them are zeros. And what's crazy about the zeros is they're not all out of business. Maybe 3 of those are out of business, and 1 of them just stopped growing. And when a company stops growing in this paradigm, it doesn't have any value anymore. So if you try and sell it, nobody wants it because nobody wants a company that doesn't grow. And so they just write them off. So you take the weighted average of that and you get 2.3. Real life, when these numbers are slightly different, 2.2 to 2.8. 3 would be a great portfolio. Right? So that's 3 winners and 7 losers. This is why we talk about 90% of tech startups die. Okay. Again, this is a successful portfolio. There's a lot of non-successful VCs. So, some win, most lose. And they're fine with that. And as an entrepreneur, I'm a self-identified entrepreneur, and I've been for a long time, as an impact investor, I'm not willing to do that. That's bad. I like it when 2 fail and 8 succeed. I can live with that. I'd much rather have it be 9 and 1, but it's going to be 8 and 2, no matter what. Alright, so the real goal is not 10x. Really, that was a 1 out of 10 fluke, right? That's not the actual goal. The actual goal is 2.5 times your money value. And we didn't talk about time frame. What they want in time frame is 3 to 5 years. What they get in time frame these days is 7 to 9 years. It took 10 years for Facebook to go public. Some of those investors were in Facebook, 3, 4 years, 10 years. Uber's not public yet. It started to take a really long time. But the investors don't actually usually compute the IRR. They usually compute the cash-on-cash return, as it's called. It's 15% internal rate of return. Right, so if you take the 7-year period or the 10-year period and you figure out when those returns are going to come in, the losses are going to come quickly, the winners are going to come later, you get 15%, and Excel will compute this for you. This is IRR just means what it would be if it were a flat interest rate. So if you put the money in the bank and the bank paid you money, it would be 15% on your money. And so the reason why it's 15% is because that's better than the public stock market. So our benchmark in the US is S&P 500. That average is 7.5% over time, right, over any 10-year period. And so 15 is better than 7. You're taking more risk, you should get more return. That's another theory we can debunk. And so you should get 15%. That's good. But you put your money in, you see a lot of losses, and then someday later, something good happens and you feel better. But it could be like 5 years later when the first one hits. And then it's done good enough that, if you put it in the bank, you would see a stream that looked like it was 10%. And then another one will hit. And now it looks like your stream would have been 12. And if it hits like that box, you get to 50. And if you have a huge hit, like Facebook, it could be 50 or 75. All right. So the first question I have for the room here is sometimes this doesn't work in, not just this, but anything in startup land doesn't work because the interest rates don't come out right. So in the US, if I put my money in a bank, in a savings account, they pay me at best 1% interest. And if I buy a government bond for 10 years, that same time period, I think it's 2 and change right now, maybe 3 and change, but it's around 3%. So that's super safe money. I'm sure I'll get that money back in 10 years. And over time, I'll get 3%. But I know this from talking to the people at FLE, which is the Impact Investing Conference in Mexico. Mexico has a high inflation. The banks there pay, I think it's 8% per year on the savings. So why would I try and risk my money when I might get 12 or 15% in this scheme when I can just put it in the bank and get 8? Right? These numbers don't change in this model just because you live in Mexico. Right? You don't automatically get a 20x just because you live in Mexico to try and get that to 25. Yeah, so you can see that your baseline of where you have to beat is the spread, the difference between what you have, what the normal unrisky money is and the risky money. You got a lot tighter spread, which is one reason why people aren't doing angel investing in your community. Is why should they? Right? Just leave the money in the government bonds. That's the more rational thing to do. So there are 2 known ways to invest in companies. I'll do this really quick, because you should know these already. One's called debt. And all the charts have the same basic structure to it, which is the green money is you as an investor paid out to a company. And then in this case, the company promises to make a bunch of payments back to you. Right? They're all generally equal-sized payments. Right? And this is just the hockey stick revenue of the company. And what you can see here is the problem is they can't afford the first payment, or the second payment, or the third payment. And maybe, if they're lucky, they break even on here in terms of paying you, and they can afford the 4th payment and it gets better. But in real life, revenue growth is more like this. So it's like they can't afford to make any of the payments. So that's a problem. And if you really want to make 15% or 20% because you got to beat the banks, well, then you have to charge. This is like the American style, this would be a 7% loan. But if you really want 15 or 20%, you have to charge 15 or 20%. But that assumes every single dollar is going to get paid back in the debt. That's not true. Some of them are not going to pay you back. So you can't charge them 15% if you want 15%. You have to charge them 30%. This is why we don't do debt for startups. Equity is simpler. You give money to a company and they promise you nothing. So you hand them money, you get a contract. The contract says you own a percentage of this company if someone ever buys it. They'll promise to pay you nothing forever. There's no time limit, there's no maturity date, there's nothing in the contract that says you'll ever get a dime back. And yet this is the paradigm. This is what everybody is doing. This is California capitalism. Someday you hope that someone wants this company more than you. And that this bar here is 10 times bigger than that one. That is the equity chart. There's a third way. And the third way is really simple. Again, you hand some money to a company, and what they're promising you is a small percentage of their revenue. So we know it's affordable because if they earned $1 here and you're taking 5% of their revenues, and if they earn $1 million here and it's 4%, they're paying you $40,000, $50,000. We know that's affordable, it's based out of the revenue. What you do here is you fix the total amount that they're returning, not the time. So I'll show you an example here. Let's just call this, you can do this in a bunch of different varieties. This is a revenue-based loan. So let's say, we can do round numbers. So $100,000 gets invested into the company. They're going to pay a single-digit percentage of top-line revenue. It doesn't have to be top-line, but we're going to call it top-line here today. So that's underlined because that's a variable. They're going to pay you monthly. That's a variable. It could be twice a month. It can be once a quarter. It could be once a year. Loans are usually done monthly. Totaling a certain amount of money. In this case, it's $200,000, which is twice the investment. And that is basically the whole thing. You can do that on a single sheet of paper if you trust the entrepreneurs. That could be your entire contract. I have longer versions. I will share. Anyone who wants the actual documents in the US, happy to share it. I do have some documents from Uganda as well, which might be more useful. Alright, you can do this as equity, which is the way I do it at Fledge. I do both, but I do the equity version in my accelerator. And we don't do $100,000 yet, but I want to keep them the same in the 2 slides. So imagine the $100,000 gets invested. What happens is it buys some shares. What percentage of shares? That's negotiable. It doesn't really matter what percentage of shares. Because the company is then promising to repurchase half of those shares, where half is a variable. It could be 3/4, it could be all, it can be 1 share, that's also negotiable. I did half, and that prolific investor, when I came up with this, I had an aha one day, literally, February, I don't remember what day, 2011, and I went, oh my God, I can do it this way. I'm walking down the hall, and he's officing in the same venture capital firm as I am. And I say, Jeff, I gotta run something by you. How about this, blah, 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 blah. And he goes, yeah, but if there's a 10x, you left money on the table. And I said, oh, well, what if they buy back half? He said, oh yeah, that would work. And then we parted ways. So it's been half ever since. That's how all the venture capital stuff got created in the first place, was conversations that short. And so in this case, the norm is half. And so they buy back half the shares at a price that returns, in this case, $200,000, using, again, variable single-digit percentage of revenues. I do quarterly because it's less paperwork, and 2x gives you the $200,000. Okay, makes sense? You buy shares, they buy them back. That's revenue-based equity. 2 big variables you play with. Well, the third one that's not mentioned here is how much money you can invest. But then what percentage of revenues are you going to take? What cash-on-cash return do you want? And also your spreadsheet gives you the IRR from that. And then what else do you want? So do you want to do this as debt or equity? And that is usually based more on taxes than anything else. So interest on this in the US is tax deductible to the company. If you get a return in the equity version of this, we pay way lower tax rates for capital gains in the US. That's why I do equity as a capital gains. The other piece on here is, do you want any upside? So, if you do the 2x deal, but you think this company might grow bigger by having them buy back half the shares or 2/3 or 3/4 of the shares, in this case, having that extra equity gives you a little more upside. Do you make them optional or mandatory repurchases? Okay, prepayments. I've seen lots of different versions of that for different reasons. And then you can use every other preference you've ever heard of in early stage investing. You want a board seat, you want a first right of first refusal, you want them to have to go to you and get approval to hire a new person and so forth. All those things are up there. And if you do that, you see that it's not actually 500,000, but basically every company is investable. The only question is how much can you put in, and how much risk do you want to take, and how long do you want to be paid back. So, second question in the room, have you seen anything like this before? So the difference between revenue and profit, real quick, as an investor, you don't have any control over profit. So you gave them money, they said they were going to do this, they gave you a financial model, you agreed with them, you did all the due diligence, or in the accelerator version, you built the financial model with them, they said they were going to do this and so forth. But what happens in real life in startups is something comes along, an opportunity comes along they can't pass up, and it will cost them money to go grab it, and now their profits disappeared for a few more months or another year or something. And as an investor, you're like, well, I was expecting to get this revenue payment, and now I'm not. And that keeps happening, and that disappoints investors. And they have no control over it whatsoever. So I like the top line revenue because there's a simple definition. The money that came from customers is the top line revenue.
And easier to measure.
Yeah, and everybody wants it to be bigger. Like everyone can talk about it on a weekly basis. How was revenues last week, last month, today? And what can we do to make it bigger? And nobody ever complains, right? In the profit case, it's like, well, I really wanted to hire that person. This great person came along. And now there's a mismatch between investors and entrepreneurs. In the revenue version, the top line revenue version, yeah, sales were down last week. Okay, that's a disappointment, but we know that happened. What can we do to fix that? Sales were up last week. Everybody's happy. You never have to fight over like that was a bad idea. Right? So personally, I only do top line revenue unless the only case I've had is some companies where the revenue isn't theirs. So I don't remember mine, but credit card processing company. The revenue that's paid from the customers is not the revenue to the credit card company. They have to pass that on to the stores. Their revenue is 2% of that. So then I would do adjusted gross revenue. If no one has mining in their country, anyone seen mining deals? This is the norm for mining deals. It's also the norm for oil wells, at least in the U.S. and films. So if I'm a famous actor in a movie, they could say I'm going to pay you $10 million to act in my movie, and my agent will say that's great. I'll take the $10 million in 2 points. And so there's a revenue share off the top, but there's no cap, right? Because there's a third version of this that I didn't do the slide for, which is just straight up royalty based. There's a group out of London that does $5 million minimum checks. They don't do debt, they don't do equity, they just get 5% of the income until a certain amount is paid back. Simple contract. Okay, the harder question. Is this legal in your country? So I've done this in 26 countries. What I've learned so far is I can't do it in India, but people in India can do it. And the reason why is that foreigners are not allowed to lend to companies in India, and this could be interpreted as lending even in the equity version. I can, again, same thing in Mexico, I can do it, but I may have a hard time getting my dollars out because Mexico doesn't want the dollars to leave. They'll let me do it, it's totally fair, they just might stop the dollars on the way out. And in Malawi, I did do the deal. Everything looked great, and then when we tried to make the first payment, the bank was all ready to do it. The central bank of the country said no. I have yet to find a place where this is illegal within the country. Because it is debt, or it is equity. It just has a little twist to it. Alright, so we're going to do one. We'll pull up, we want groups of 3 and 4 here. So for this case, just assume that you have 100,000 units, right? You put that in whatever currency you want in your head to. You have to invest it because you're part of a family office and this family is telling you have to invest it, or you're part of an investment group, and it just has to be done. It has to be done now. I'll give you a few choices of companies, and then the 3 questions that you're going to ask as a group is, how much do you want? How much do you want back? What's fair? And there's a huge range of what's fair. How long do you want to wait until it's all paid back? How patient are you? I heard the word patient capital. Patient capital is nice in that other paradigm. In this paradigm, you're a little bit impatient. You would like to see some money back because it makes investors happy. You're an investor in this case. And then what else do you need? Okay, so I'm going to give you 3 companies, and if anyone else wants to add one in, it's fine. You don't have to pick which company in your group. I just found when I do this workshop, it's useful if you have a company in your head. The terms are going to fit on a post-it now. Alright, so what's crazy in the United States is that every escargot is imported in a can from Europe. Don't order escargot if you're in the US. It's not good. It's rubbery. Little Gray Farms is fixing that. They're a organic lettuce farm in Washington with a really bad snail problem. Over Tanzania is the only producer of sunflower oil in the country of Tanzania, which produces gobs and gobs and gobs of sunflowers. This is one of those great cases where they really don't need money. They just need more processing equipment. But the only way to get more processing equipment is to bring in money. And then one of my most impactful companies is Jolex. Kampala, Uganda has 3 million people and 2,000 toilets. Yeah, we're putting in paid toilets in Uganda. Nice and simple. So let's just assume that with the $100,000, that any of these companies will earn $250,000 in that subsequent 12-month period, right? And then they're going to grow not that much bigger after that. They're going to grow to 350 and 500 and 650 and 800. And as you know from working with companies, we can't predict 5-year plans, but we need 10 years for this model. So we're just going to assume some more growth, but we're going to stop at $1 million. That's a lot of money. So if you had an investment that took 100,000, I need a generic term for money. If you had a company that took 100,000 tea bags, and then that's all the money they ever took from investors, and a few years later they were earning 1 million tea bags, that's a good investment. That's a really good investment for them. I like this. I find a lot of this. All right. So we're just assuming you already like the team, you already did the due diligence, everything pans out. All you need to do is figure out what the terms are going to be for this investment. In order to figure that out, there's a spreadsheet. Spreadsheet's online. I can point you to it. And so the way this works, and this is an actual screenshot of the spreadsheet, you put in the investment on the top and what multiple you want. And it will compute the multiple for you because it's not always 2. It can be 1.5, it can be 1.2, it can be 1.875. It doesn't matter. It'll change the numbers that come out the bottom. And I've done deals at 1.7 and 1.8 and 2. 2 seems to be a number that a lot of people fall to. You stick the revenues in this column. Now we also know that they never actually get to the revenues that they tell you. So you do this and then you do it again with the revenues that you think they're going to make. It doesn't really change it that much, surprisingly. It computes the growth rate for you so you can just see what that is. And then at the top of this column is what percentage of revenues you're going to take. This 2 doesn't have to be a round number. So in real life, in here you'll pick one. I'll show you a few examples. But in real life it can be 2.5 or 5.5 or 3.75. So in this case it's round 3. And then if you've never seen this before, so this is negative, parentheses is negative, this number for the first year. And it's doing this in annual amounts because it's shorter. It's easier to see. And so this is 3% of that amount. So at the end of at the beginning of year 1, we put $100,000 in. At the beginning of year 2, we get 3% of last year's revenues. At the beginning of year 3, we get 3% of year 2's revenues and so forth. And it computes that for you in the spreadsheet. And it shows you the sum at the end of 10 years. And in this case, you didn't get to 2x. You only get to 1.94 and you only earn 12.4%. This is the internal rate of return of this cash flow. So if you wanted 2x, you can't pick that. If you wanted to be paid back in less than 10 years, you can't pick this column. So there's another column. So let's just try 5%. So in the 5% case, it figures out the numbers and the spreadsheet will automatically calculate that last year's payment so that it comes out to exactly what you want. And in this case, you get a 2x return and a 17.4% IRR. Okay? I've been in rooms where they say that's too high, so we need to do 4. Right? So this shows you some snares. Again, it doesn't have to be odd numbers either. But two more cases in case that's too slow for you. We have a 7% and a 9% case. And so in the 7% case, it takes 7 years. In the 9% case, it takes 6 years. The rule of thumb is do a single-digit percentage. Don't do anything higher. All right? So the questions for your little groups, right? Again, 3s or 4s, is do you want to do debt or equity? And why? Which percentage of revenue, what X return, I'll show you the spreadsheet in a minute, and what other stuff do you want to throw into the deal? We're just going to assume in this case that I'm the entrepreneur, and each group is competing for the right to invest $100,000 in this company, and I only need $100,000, I'm only going to take $100,000, and so you're going to bid your best and final offer. You have one shot. You really want to invest in this company. So best and final offer, and I will tell you feedback in the last part of this why I'm turning you down. Alright, so that's a bit of a struggle. First time to do it? Yeah. But the cool part is now that you've done one. Right? So now you've done one, and now when you do it for real, you'll remember that doing this. You'll go, that one was a bit of a struggle. Now I kind of understand basics. And the next one will be a little easier and a little easier and a little easier until, I do the spreadsheet, it's like 5-10 minutes. Unless the numbers don't work out. Sometimes the numbers don't work out. Sometimes they say they need $100,000 and you do this and you get to the bottom and it's only 1.2 no matter what you do. Then you go back to them and you need too much money. That's too much money for you. And what's lovely about this model is it shows you that's too much money for them. Right? And it's all based on their revenues. So honeymoon is you don't have to make the payments for the first few months, for a few quarters, for a year. I do these once in a while. They're really popular because it seems like they're helping the entrepreneur a lot, right? Because you're not extracting that first few payments. That's why we do them. In the downside of the honeymoons, the reason why I try not to do them, and I don't do them at all for Fledge in the accelerator model, is I want them in the habit of paying me. And it's not a normal thing to do to pay your investors. And I have investors. So if you guys are going to follow this model of investing, you're going to have investors. Right? So you're the investor for the graduates, but you have investors behind you. You have to make them happy. And there's one way to make investors happy. They're ecstatically happy, which is pay them. And it doesn't matter whether they give you $10,000 and you give them back $100. Right? Tiny little slide. They're happy. Because every other investment that they made is not paying them because it's using the other model. In one case, I had my investors do the terms because it's their money. And so I said, you guys, and I wanted to teach them how to do this. I said, you go do the terms. Right? If you need my help, I'll jump in. I'll review whatever you come back with. I will do the actual paperwork. But you tell me what the terms are for this deal. And the entrepreneur, he loves honeymoons. He said, I want a 1-year honeymoon. And he wanted, don't write this one down in your thing yet, if you want to change, 3 tranche investment with that. So $150,000, he wanted $50,000 now with a 1-year honeymoon on that, and then $50,000 in 6 months with a 1-year honeymoon on that, and then $100,000 a year after the second tranche with a 1-year honeymoon on that. And then the spreadsheet takes more than 10 minutes.
Right.
And then it's quarterly payments and they got complicated. Yeah.
Can I just ask a clarifying question? Mm-hmm. From everything you said the last few days, it sounds to me like you're investing in your enterprises this way.
Yes.
But this is also the structure you're using for your investors.
No. I run a venture capital firm. They've given me money. They expect it back. And then some. And so the nice thing about this model is there's cash flow. When the money flows back to my fund, it flows through my fund back to my investors. So when the income comes in, there's a total amount of income. If it came from the companies, then that money is not mine to use as operations. It belongs to the investors. So you take, if $50,000 came in, then I have to send $50,000 out to the investors. Right? And they get their percentage ownership of the big pool of capital. And then once they've paid all the money they put in, we split the profits. So for anyone who doesn't know, right of first refusal is when the next investor comes along to buy in, they have the right to buy that before that next investor. Or if any employee wants to sell, those first investors have the right to buy those shares first, before anyone else. Standard practice in California capitalism, totally reasonable to ask. And that was debt, right?
Debt.
Right, so I got a debt offer and an equity offer, and it's getting complicated here. So let's try a third one, because maybe there's a better one in the room. I'm going to pick on one thing there, which is board seats. So we had two people ask for board seats. Three? Everyone has board seats up here? Okay, so and that could even be if an angel group combined raised the normal amount right now in scale is $500,000 for a company. If $500,000 gets raised, the $500,000 gets a board seat, and then the owners of that $500,000, because it's usually 15, 20, 30 people, collectively decide who sits on that board. And being on a board is a big thing to do. And it's also the one constraining factor that venture capitalists have, which is it's only really physically possible to sit on 6 boards. So if you have 2 partners who are doing investing, you can make 12 investments if you take board seats. And if you don't take board seats, you can do more than 12 investments, but you give up some transparency and some control. Or, I didn't put every preference in there, or you just simply list the things that a board would have a decision power on, and you can actually put that in your contract. You could say, like, hiring and firing the CEO is usually a responsibility of the board, but can be a responsibility of the investor crowd who put in this money. And same thing with setting the salaries of the management team, or taking on more debt. Those are preferences that you can add into an investment as well. So you can get almost as much power without doing the board seat, without also taking the risk of being on board, because boards come with risk as well. So personally, I don't do many board seats because I have 81 investments, so that doesn't scale. I'll only do board seats in the follow-on investments if one of my investors wants to be the board member. Or there's been 2 cases where the right thing to do with a foreign company was to incorporate in the United States. I typically don't do that. And in that case, I incorporated the company myself because I know how to do that. And I put myself on the board because somebody had to be on the board. Somebody had to actually I have to do the tax returns and whatnot. I'm the treasurer of a bunch of companies. So don't operate in the United States for that. This is how angel investors learn what the preferences are. Is they sit in little groups and they're going like, what are the terms going to be? Or we're going to take these terms and we're going to edit them. And someone in the room knows what this one means, right? And explains it to the rest of the people who don't. Or if it's a really small angel group in a rural area or a rural country, they go on Wikipedia or Investopedia and they look it up. Right? They're all explained in detail online. So this one was interesting. So they said, no, we are going to have a time frame. So it's 5% for 5 years, whatever that comes out to be. So we don't know if that's, we can say that it's probably this amount of money, but this company could take off and they could be paid back 10. 10 would be probably crazy, but 5 times their money back in those 5 years. And then they want their capital back, their original capital, which is always interesting. You think about, you handed them $100,000. Often the investors have this strange notion in their head that, well, that's their original capital, and then anything that comes back is new capital. And even if you gave them back 3 times their money in this stream of payments, they still want that original money back because it's still stuck there. Even though they had some back, that's more than that. There's this weird piece to it. I have that issue as well. So there was a group out of Santa Barbara, California that actually riffed on this, and they said, we're going to do it differently. We're going to do we put money in the company, they have to pay a dividend as soon as they can. And they have to keep paying dividends until a certain amount is paid. And then at that point, they buy back the original shares. So rather than basing it on, in this case, they were trying to do profits. And they married profits with dividends, kind of. So this is kind of the same thing where it's a 1x return. You're buying back those shares, exactly I guess you got a 2x built in. So it gets a little interesting. I have seen 50 different variations of this. Not all of them have been executed. But what's interesting in this new paradigm is there's no norms yet because there are not enough of us doing it, so we don't know what normal is. The only thing I can point to that keeps coming up over and over again is 2. 2 seems about the reasonable number And you get IRRs that start to look too high in some cases, but fall into the right range at 2. And then some people do less because they're impact investors, impact first. Some do less because it's growth capital. And every once in a while you get a greedy person who says, I want 3. But I've never seen higher than 3. Just because we all came up with about the same numbers, which is also common in the workshop because we only have 20 minutes. The one that I was hoping you would bring up was the idea of, well, for the first year or 2, we'll do 3%, and then we'll up it to 5, or we'll go 3 and then 4 and then 5. Right? As the company grows in revenues, let's increase the percentages. The one real deal I did like this was first money into a company. We had no idea if the projections were anywhere near accurate. We had no way to know if it was accurate. So if your numbers come true, if you hit your revenue targets, then we're going to charge you, I don't remember what it was, 4%. We're going to take 4% of your revenues. And if you don't hit those, and you hit our numbers, if you do between our numbers and your numbers, then we're going to actually charge you more because your company's a bigger risk. Because it's a bigger risk, we need a bigger return. And that company failed. So it never even got off the ground. Right? So then they didn't even make the first number. They didn't make the first dollar. But it was an interesting way, and it sounds backwards. We take more if they do worse, but in this case, we were trying to say, if we were taking a bigger risk on this company, we deserved a higher IRR. And seriously, if they were way off on their numbers, our numbers were way below their numbers, then it was going to take like 9 years to pay back on the 4%. We were going to get it up to like 7 years on the higher rate. But what I have happened many times is I'll take their revenue projections, not even mine, I'll take their revenue projections and I'll plug in, go back a few slides. So their revenue projections, I'll put in the amount that they're telling me and 2x, so that's where we start, and nothing finishes. And I'm patient, but I'm not 10 years patient. I have investors to pay back. And the odds of them ever getting to year 10 are pretty low. Right? So if it takes 7 years to get your 1x payment back, that's a lot of risk. So I'll go back to them and I'll say, you're just raising too much money, it doesn't work. And what I'm not showing here is the other tab. The other tab in the spreadsheet that you'll have access to, we'll do a computation and show you a traditional loan. Put in the amount you want, the amount you're lending, your interest rate, how many payments per year, and it will show you the payments. And so what's interesting, and I've learned in doing this, is some of my African entrepreneurs just want a traditional loan. If it doesn't work here, it doesn't work there. This is a really good predictor of whether or not that's the right amount of money. And I think it's a really good, not that I do all out of California capitalism, but I think it's a really good predictor of whether that's the right amount of money, even in the California model. Because if you put in $100,000 here, and in year 7, 8, or 9, they're not earning enough money to ever get you even $100,000 back. I wonder if they're going to get to 10x. Right? So this is a really good just analysis tool in general of what's the revenue growth compared to the amount of capital invested to create those revenues. Draper Fisher started a fund in London, Draper something else. Check this screen. Starts with a W. Doesn't really matter. Their minimum check size is $5 million. So somewhere between $5 and $10 million. And again, this model is used for oil wells and mines. So $100 million, you just need enough revenue. The key is it only makes sense if there's big amounts of revenues or small amounts of investment dollars. Personally, the largest one we've done is $150,000. And the place where I found this, again, I did not invent this. I found this model in Seattle. There's a company that's called Lighter Capital, Lighther. They do revenue-based loans. They do them for growth capital. So I showed you that chart. I said we do seed capital. They do growth capital only. So they only invest in tech companies that do not have venture capital dollars in them. So the rest of the pyramid, that have good margins, that have been in business for at least 2 years. They already have revenues. They have increasing margins when you add the new growth capital and so on and so on and so on and so on. They do two a week, and the average investment they make is $300,000. So they're the most prolific users of this model. They always do debt, and they do between a 1.5 and a 1.8x return, and they structure it so it takes 2 or 3 years to pay back. And they make a lot of money.
How many of these investments have you done so far, and what's the average return across your portfolio?
Great question. We've done 81 fledglings, and I think 3 of them we did not do in this form. So 70-something there, and then we've done a bunch of follow-ons on top of that. And then personally, I did some in this form, as did my friends in Seattle. And it's too early to tell what the return is, because as you saw, it takes years and years and years to get paid back. Twice we've been paid back completely. We have a lot of them paying us back, and most of our fledglings are only out of the program 2 years because we've been expanding. So you gotta ask me in 5 more years. My paper says, my spreadsheet that's predicting what happens, says this is gonna do just fine.
Any defaults yet?
Oh, sure. Yeah, we have 15 companies that have given up. What's interesting is that many of them started paying us back. They didn't go out of business because they had no revenues. They went out of business because they didn't have sufficient revenues. We got a little bit of our money back.
How much capital is being deployed to non-American companies?
I know the number's like 2 million in Africa, and then we have a bunch of Europeans and elsewhere, so 2.5 million out of my funds. And then my partner in Peru has done another, $500,000, $750,000. Like he invests in dollars.
Yeah, you've done a great job of telling the story of how great this is. What are the downsides?
The biggest downside is that you know how this works. Another 400 people have been in this workshop in various places, and they know how it works. The vast number, 99.9% of the other investors have never heard of this before. So if you're going to try and invest with someone else, you're going to have to educate them. 99.9% of the entrepreneurs have never seen this before. So if they are writing their terms, which is the norm for capital, they're not going to pitch this to you. You're going to have to sit down and say, that's nice, but you're not investable in that form. Let me show you another form. And at least the ones I'm coming across, often there's already one investor bought into their ask. So you got to undo that investor. So the friction of doing one of these deals in the real world gets in the way. What I've proposed to many entrepreneurs, and I don't think anyone's ever done it yet, is you can propose your terms that we're selling a bunch of equity that's revenue redeemable. That's another term that's like this. But for every investor that comes in, you tell me whether you want that to be 0%, 25%, 50%, 75%, or 100% redeemable. And so in that case, if you make it optional to the investor, then the California investor can come in and say, no, you guys are crazy with your redemptions. I'm in it, 0% return, 0% redeem. And the full-on, more philanthropic, less patient or more aligned capitalist can say, I'll take 100% of my capital purchase back out at 2x. And they can live in the same document at the same time in the same deal. And so you can get away with it. You can get past that. But I haven't seen that actually executed. What I have seen executed is the redemption optional or not at the time of the redemption. And that turned into a nightmare, trying to gather all the cats together to see who wanted to be redeemed. So I don't recommend that with a group of angels. And there was one more thing before I let you go to lunch. The other downside of this, and the only objection I get that's anything reasonable, is, but you're taking money out of the company. And the answer to that is yes, absolutely. We're taking money out of the company, just like the landlord takes money out of the company, just like those damn employees take money out of the company, just like every expense you have takes money out of the company. This is saying the capital has value, the capital has a cost. The cost of the capital, strangely enough, is in the same currency as the capital, but you're paying for your capital and you're paying for it on a monthly or quarterly basis, just like you pay for everything else. It's budgetable. So, but it is an objection and people don't think that's reasonable and they're wrong. Right? So leave it at that. Just remember, it's a paradigm. We got to break it. And for the rest of the details, there's a book.